What's up, everybody? Welcome to the November 2025 IndiView Market Insights monthly update and outlook piece. Today, we're going to get into just kind of the hot button issues, not so much from a weekly perspective, but a little bit of longer term lens. And again, on a monthly basis, like we're doing right now, we'll just provide a more brief update. Usually on a quarterly basis, we do a little more robust one, but this is more about what's performing, what's not, has any of our opinions changed or anything like that. So let's get right into it. Let's start with asset class performance. October really kept the momentum of the markets going, and there are a lot of positive numbers in here. I can't say it any other way. If you look at the S&P 500, now 17.5%. This is as the end of October. But look at those international stocks, 27 and 33%. This is, again, barring any sort of collapse coming in the last couple of months, which we do not see, and we're certainly not forecasting. It could happen, but it's not something that's our base case scenario. This is going to go down as one of the stronger years in international markets in a very long time. So very, very strong international performance. U.S. performance is nothing to sneeze at. I mean, 17.5% is very, very good year. So don't get me wrong, but the fact that the S&P 500 is lagging international hasn't happened very often over the past 10 or 15 years, but it is happening this year. But both of them are very, very good. Turning to fixed income. 6.8% is a strong year for bonds. If that holds for the remainder of the year, 6.8%, again, from a safety component, from a relatively lower volatility, to be able to get near long-term averages of the S&P 500 is in that 8 to 10% range. So just from bonds alone, it is really not, while it is lagging compared to the stock side of your portfolio, historically, this has been a very strong year, which leads that balanced number. If you owned a little bit of all this stuff in kind of more of that 50% risk of the market kind of approach, or 60-40 kind of thing, you'd be up 15% this year. That is very, very strong. I'll get into that in a little bit about how unique this is, but across the board, we have a lot of green. And turning that into some alternatives that are on the right-hand side there, gold through the ETF symbol GLD. That's kind of how I use as a proxy. That's up over 50% year to date. Again, as of the end of November. Bitcoin, IBIT, is the BlackRock Bitcoin ETF. That had a little bit of a rough October. That came down a little bit, but still up over 17% year to date. So again, if you were to throw those numbers into the overall asset class performance, again, more positive. Now, the gold number would be significantly higher, but even the Bitcoin number would be a relatively good year across the board. So there is, just to be completely honest, from a performance perspective alone, there's not really a lot to complain about in the overall markets. Turning to a little bit more granular summary here. So this is a broader view of global stocks and sectors. Really just wanted to call out a few things. I talked about it before in the asset class performance, but this shows it as well. It's rare when almost everything is working. And really right now, with the exception of some sectors, which I'll get into here in a bit, but most everything, if you have a diversified portfolio right now, you're probably doing pretty well. There's just not that many asset classes that are lagging or, are in negative territory. There's a couple, but it is few and far between. So chances are most portfolios are in the green to significantly green this year. And again, it really, it matters to a certain extent how you're weighted and how much your performance has been. But generally across those assets, whether you're conservative or whether you're risk oriented, you've generally had pretty good performance overall. If you look at U.S. yields, the Treasury yield, so if you look at, honestly, 3 to 30 years, 3 months to 30 years, most of those numbers since the beginning of the year have come down. That is a tailwind for bond prices. I told you before, fixed income is about 6.8% year to date as of the end of October. A lot of that comes from the fact that yields are lower. So when yields come down, bond prices typically rise. So they have that inverse relationship. So bond prices have benefited from the fact that yields have come down since the beginning of the year. The other thing, and we've been talking about this for a few months, is that the risk premium, the amount you get for taking on potential default risk, which can vary from very little, your high investment grade bonds, all the way to riskier, your high yield, and especially your deeper high yield type of stuff. You take risk and you expect to get paid for taking that level of default risk. Well, that's been pretty low, and it's stayed pretty low for the most of the year. We had a little bit of a hiccup not too long ago. I think we had a little October, but we really kind of rebounded back to the low levels again. So when the premium rises, or what you expect to pay for taking on that default risk, when that rises, people expect a greater premium, and that usually causes bond prices to fall. But when it's stable and people are generally saying, I'm okay with taking that level of risk, and yeah, this isn't great, but I'm getting paid to take some level of risk here. When it's stable like it is now, again, it's a tailwind to at least a neutral for bonds. Neutral, and I would say a little bit of a tailwind this year, is that number just hasn't risen. So you've had two natural, basically, tailwinds in the bond market that has allowed us to have, again, 6.8% as of the end of October. Is it stock-based performance? No, it's not as good as the stock market. But from a bond-based perspective, that's not what you're expecting. You're expecting lower volatility and some income generation, and you've had some price return components to increase that as well. So it's altogether been a pretty good year for bonds. Turning to the sector side at that bottom left there, tech and consumer services have been leading the charge. Not terribly surprising. That tends to be where the Mag 7 lives. So the Magnificent Seven are those seven, very, very large companies. And a lot of them live, Microsoft is in technology. Amazon is that's actually in consumer discretionary. But Google or Alphabet is in comm services. Meta is in comm services. These companies, Apple is in technology. NVIDIA is in technology. So you have natural tailwinds from, these stocks have been what is driving the market over a longer period of time, these kind of high concentrated Magnificent Seven. I would put Broadcom, who is not in the Magnificent Seven, as one of these drivers too, because it's in technology, it's relatively large, and it's done very well this year. So across the board, there are things in those sectors that are just driving the performance upward. There's been a natural inclination to want to own these things too, and that's driving the prices upward. What are the things people wanting to own less of? Real estate and consumer staples. Consumer staples I get because inflation tends to be difficult for some of them to pass through, but also it's just the component of they tend to be slower growth, right? It's Procter & Gamble. It's companies like that are just not as high growing as these tech and communication services companies are. And so they've been kind of left aside for chasing and going into these concentrated elements of the market. REIT's a little bit more surprising because historically, when you have inflation coming down, and inflation's still elevated, but it's getting more in the normalized territory. We're still above that. But usually when you have that area combined with lowering rates, usually that's pretty favorable for REITs. My guess more than anything else is the component of real estate in and of itself, and just the fear that, hey, in a potential correction, we might not be wanting as much physical real estate and those kinds of things. So again, I think it's much more of a pressure of people getting rid of some of these things to own the stuff that's been working here lately. So I think that's part of it, but those two have definitely lagged compared to the other sectors. Turning lastly to oil. Oil prices are down 15% year to date now. Again, this is a consumer benefit. That acts to a certain extent as a tax cut, right? Because chances are, whether oil's at 60 like it is right now, or whether oil's at 80, for the most part, you're probably still going to drive to work, right? Or drive the kids and drop the kids off at what they need to go to, right? So your behavior doesn't change a whole heck of a lot in that range. I'll extend that out a little further here in a second, but within that kind of range, it is cheap. When oil prices are cheaper, that means gas prices at the pump are typically cheaper, and you're doing the same thing for less money. When it turns, goes from 60 to 80, now you're doing those same things. You're still dropping the kids off, still going to work, but now it's more expensive to do so. So it kind of acts as a tax. So being down 15% year to date acts as a little bit of tax relief to a certain extent, or at least consumer-based relief. I still think that's a benefit. At $60, that is more. And I think you've probably seen this at the pump. Some of you, gas prices are never fun, but I don't believe they've been egregious this year because that oil price has come down a bit. I'm always careful in saying that could turn on a dime and that can get very expensive very fast. And usually from that 60 to 80 range, usually you don't see a lot of behavioral change, some, but not a lot. Above that $80 range, as we start to get especially into that $100 range, you start to see some behavioral change because the number just gets too egregious and people have to adjust what they spend. But in this area, in the $60 to $70 range, I think it's absolutely fine and a tailwind to the consumer overall. So as always, we do in the shorter ones here, we're going to do the path forward, an update on the path forward. We provide this every month, but on a quarterly basis, we provide a more robust look. And then on a monthly basis within those quarters, we say, how are we looking? Are we changing our mind? Is it still on track? So that's what we're doing right here. So let's start with the outlook here. Is the first thing we said in October, in the end of September report, which came out in October. Will we ever get scared again? Chances are we're saying yes. We're certainly not feeling that yet. I still think it's coming. I still think, corrections happen all the time in the markets, and usually people assign reasons to them after the fact to try to figure out why it happened. It could happen for a variety of reasons, especially in an elevated market like now, especially one that has run as aggressively as we have. You should prepare yourself for some level of correction coming. I'm not saying the crash, I'm not saying world is ending, but it's more likely that we will face that potentially this year or into early next year. But we just haven't seen. Some of the indicators are suggesting there's more fear in the market, and certainly the concentrated element has gotten a little bit more aggressive. I'll show that in a second. But overall, we're not experiencing generalized fear of a correction at this point right now. At some point, it will come back. Housing, I talked about how lack of affordability in housing. I think that's going to be a continued story. I don't see any change in that right now. Mortgage rates, 30-year mortgage rates have come down since the beginning of the year. So that is a benefit. But we're still at an area where housing prices compared to historical income, if you look at that ratio, we're at levels that are above 2005 and 2006. Again, this is not 2005 and 2006 when 19 people had 19 different mortgages and had 5 different houses, and all the excess that was built up during that time is not there. This is actually a matter of not enough excess supply out there to satisfy the demand. And so housing prices have stayed high, and even at lower interest rates, the activity level is still relatively low, and we don't see anything changing that for a little bit. The S&P 500, I said how concentrated it was. It is getting even more concentrated now. There has been a component of stocks, a lot of stocks underneath, a good market, if you will. Again, I showed those numbers before. The S&P 500 is up 17%. There's a lot of stocks right now that are trading 20% below their all-time highs. There has been a pretty decent shift. Now, some of the bigger companies, again, the S&P 500 is market weighted. So the bigger companies matter more for the index. And so those have held up very well, and they've continued to rise for the most part. There's been 1 or 2 hiccups, but for the most part, those have continued to rise very well. The average stock not doing quite as well. And so that concentration level has actually risen and not gone away yet. Again, most asset classes, in my opinion, are not bargains at current levels. Doesn't mean they can't continue to go up, but expecting this level of return as your forecasted level of return or what you should expect going forward, I think is overly optimistic. I don't think you should be expecting that. I think you should actually be expecting sub-average returns over the next 3 to 5 years, because of the high valuations right now, and because, again, the bond market is really not pricing in a lot of risk. So turning to positioning, Now is not the time to be adding risk excessively. Again, rebalancing back to your equilibrium risk, your investment plan, policy statement risk is absolutely fine. And maybe even a little bit more conservative could be worthwhile to have some dry powder on the sidelines in case we do experience some turbulence and you can buy at a better price down the road. I'm not saying sell everything. I would never say that. It's not what we do here, but maybe a little bit more conservatism than you're used to, a tiny bit more, may be beneficial over the next year to give you a better opportunity to buy later on. Fixed income yields are less attractive because the Fed is cutting rates. We don't know what will happen in December, but they have been cutting rates. So your short-term yields have been reducing. I still think that's the area to be for the very simple reason, again, you're not getting paid to take a lot of risk, whether that's maturity risk or whether that's credit risk. You're just not getting paid a lot to do that, to take on that risk. I would rather take that risk when I'm getting paid to do so. Really not right now. So even though shorter term yields aren't given what they're used to, still that 3.8 to 4% range is still very viable for a very short term strategy. I think that's still the place you want to be until you start getting paid to take that risk again in the bond market through either maturity or spread via default risk. Excuse me. Turning to the stocks, there are some bargains here. Again, what I said is don't give up on these recurring revenue and defensive models. Now, that tends to be where, especially recurring revenue tends to be what we favor here anyway. In our Indy stock portfolio, it's certainly one of our more favorable things is companies that know what their next quarter and potentially even their next year because there's a lot of recurring revenue. I like that. That is my general bias is towards those kinds of companies. I think even more so right now, it's worth taking a look at and finding these models because there are some bargains out there. I told you before is that many of these companies are facing maybe down 10, 15, 20% from their all-time highs. And the relative valuation or what you're paying for them compared to what you're paying for some of these other companies that have worked very well is extraordinarily different. So I think now's the time to go searching out those bargains and maybe make some adjustments to portfolios. Lastly, on international stocks, the dollar really hasn't been has rebounded here recently off of bottoms. I think in late September, I think is where the dollar bottomed, and now we've seen some rise. But still, the weaker dollar has been fuel for the international markets. They're having a phenomenal year. I haven't seen anything change that. But if we were to see the dollar continue to progress on this upward, I do believe that will act as a headwind. So we want to be a little cautious. We still want to own international stocks, but they just might not be the value they were before. The other part of that, though, is a lot of U.S. investors have completely gone away from owning international stocks because the U.S. market has gone so strong. I do not advocate for that. I think having some international exposure provides you some diversification. This year certainly has been a tailwind. I don't get rid of that just because we've had a one-year tailwind. I still want to hold some international stocks, but understanding they've been very strong. And if the dollar were to re-engage and go back upward, might be a headwind for those companies. So that is what we have for this month. Tune in next month where we'll have another update to our path forward and also just discuss what's happening out there from a performance perspective. But until then, thank you very much and take care of yourselves.